Welcome back to the session International Banking and Finance. In last session, we have studied different concepts of international banking, finance, needs of finance, features of finance, etc. In this lecture, we will study importance of international finance, principles, advantages, and scope of international finance. First of all, we will see importance of international finance. As we all know, international finance plays a critical role in international trade and inter-economy exchange of goods and services. It is important for a number of reasons. The most notable ones are listed here. First, international finance is important tool to find exchange rate of different countries, to compare inflation rate of different countries, and to get an idea about investing in international debt securities, to ascertain the economic status of other countries, and to judge the foreign market. Exchange rate are very important in international finance as they let us determine the relative values of currency. International finance helps in calculating these rates. Various economic factors help in making international investment decisions. Economic factors of economies help in determining whether or not investors' money is safe with foreign debt securities. Utilizing IFRS is an important factor for many stages of international finance. Financial statements made by the countries that have adopted IFRS are similar. It helped many countries to follow similar reporting system. IFRS system, which is part of international finance, also helps in saving money by following rules of reporting in a single accounting standard. An international finance system maintains peace among the nations. Without a solid finance measure, all nations would work for their self-interest. International finance helps in keeping that issues at bay. International financial organizations such as IMF, World Bank, etc. provide mediator role in managing international finance disputes. The very existence of international financial system means that there are possibilities of international financial crisis. This is where the study of international finance become very important. To know about international financial crisis, we have to understand the nature of the international financial system. Without international finance, chances of conflict and thereby resultant mess is apparent. International finance helps to keep international issue in disciplined state. Now we will see principles of international finance. First principle of international finance is advantages to become international. The internationalization advantages to attract companies to invest directly in foreign countries. Second, comparative merits. Each country has its own merit. Every country is specialized in some product and has some special features. Through international trade, exchange of variety of goods, culture, services take place through trade. It increases standard of living. It also considered profit of individual organizations by trade. Next principle, economic of scale. Economy of scale means a proportionate saving in cost gained by increased level of production. It means if you increase level of production, your cost of production will be come down. The synergistic effect direct to economies of scale. When whole is more in profitable, then part of it, then synergistic effect exists. Economies of scale can be increased by deploying a real capital and monetary asset on global basis rather than introducing new product in domestic market. Fourth, effect of portfolio. As per the principle of portfolio, it is said that risk is diverted by increasing portfolio. In same way, company can diversify its risk by working on global level rather than restricting in domestic level. Fifth, perfect completion. International trade allow every country to entry in market and exit from market freely. Under this condition, goods and services are freely transferable. So, the balance of cost and return exists. Sixth principle is risk and profitability trade-off. It is well known that there is a close relation between risk and profitability. But the trade-off between risk and profitability decides the maximization of stockholders' wealth. It has to determine an optimum balance between risk and profitability. Seventh, valuation of asset. This principle says that value of an asset is the expected earning of the asset. For MNC, better marketability, earning more profit, capitalization at lower rate comparing to the domestic companies leads to higher price earnings ratio and lower required rate of return. So, the value of MNC is more than domestic companies. Now, we will see what are the advantages of international finance. First, promotion. International finance helps to promote domestic investment and growth through capital market. Second, better banking system. International finance helps to healthy competition due to which it provides better banking system. Third, more equality. It helps to integrate economy of two countries and easy flow of capital. Due to free flow of capital results into more equality between the countries. Fourth, effective capital allocation. It helps to locate countries' capital effectively by providing information related to two different areas. Fifth, capital needs. It helps to access capital market around the world which enables the country to lend money in good time and borrow capital in need. Healthy competition. International finance helps to create healthy competition in the international trade. The last one is corrective measures. Due to worldwide cash flow, international finance helps to take corrective measures to bad government policies. At the end of this lecture, we will see scope of international finance. Currently, international finance has become more comprehensive and broader in scope and is dealing with matters related to globalization, fair trade, multinational banking, multinational corporations, international finance. International finance consists of foreign exchange market, currency convertibility, balance of payment, international finance, and international monetary system. First of all, we will see international monetary system. For better economic growth and to do trade and investment efficiently in a country needs to have its own monetary system and authority who can control system. For example, RBI of India controls over monetary system of India through controlling over inflation, supply of money and maintaining interest rate. Next, international financial system. Growth of world trade, liberalization, globalization in business brought tremendous changes in international financial system. It includes various rules, facilities, markets, instruments, organizations and customs which enables the international payment and receipt between countries. Comparing to past, volume of transactions has increased in international. Next, foreign exchange market. It is a stock market in which currencies of other countries are bought and sold. International financial system provides this facility. Fourth, currency convertibility. Currency of a country is freely convertible when resident or non-resident of country are allowed to convert local currency in a foreign currency. But government of a country restrict resident and non-resident to do this. Various countries do not allow converting currency freely. It makes the international business difficult. Last one, balance of payment. It is systematic record of all economic transactions with resident of reporting country and resident of foreign countries during a given period of time. It represents summation of country's current demand and supply of claim on foreign currencies and foreign claims on its currency. It is net result of recording all tangible and intangible items which are imported and exported from the country. It is an accounting statement which shows all economic transactions between domestic country and foreign country. It is nothing but account which shows all receipt and payment of goods exported and services rendered. See you again.